Happy Friday, folks. It's Shayan with Integrity Home Mortgage back with your weekly rates rundown for July 24th, 2026. Look, there's no other way to put it. This was an absolute beatdown for mortgages this week. The Iran war is back in full swing. Oil prices are pushing back up around $90 a barrel. A looming Fed meeting next week. And if that wasn't enough, LeBron to the Sixers. Let's start with our benchmarks. 10-year U.S. Treasury yields are higher this week by 13 basis points to 4.68%. And the 30-year fixed mortgage rate is worse by 17 basis points, now sitting right around 6.9%. Mortgage markets are improved today, which is a real relief after we've had a week-long slide consistently, where we hit our worst levels in some time just yesterday. You'll recall that we ended last week on a constructive tone, right? Consumer prices, producer prices both came in lower than expected, and hope was beginning to build that maybe inflation is starting to cool, and along with it, the probability of a rate hike by the Fed. We also talked last week about the fact that this was going to be a data light week and that the markets were going to take their cues from geopolitical headlines. Well, as it turns out, those headlines were not favorable for interest rates. This week's reversal of fortunes is among the most dramatic we've experienced since the beginning of the war back in February. Mortgage rates are sitting at or near their worst levels in a year, and 10-year Treasury yields are at their worst levels in about 18 months. The probability of a rate hike at next week's Fed meeting has gone from less than 10% last Friday to nearly 40% today. Obviously, the driver of all this is the escalations happening in the Middle East. The Versailles peace deal has been thrown in the trash and then pulled back out of the trash and lit on fire and then thrown back into the trash at this point. Diplomatic efforts are completely stalled, and the block shipping routes have now expanded from just being the Strait of Hormuz to now also including the Red Sea, which is probably the most significant development of all of this. And the reason that mortgage and interest rates are taking this so hard is because of the inflation implications. Last week's favorable inflation readings were driven almost entirely by the collapse in oil prices into the high $60 per barrel range that resulted from the announcement of the Versailles MOU. With oil prices breaking back in the 90s, inflation is once again a real concern, and that's coming at a time when the FOMC meeting is just days away. Now, let's try to keep this into perspective. So, while the probability of a rate hike next week are significantly higher than they were, the most likely scenario is still for the Fed to do nothing, right? Just remain on hold. So, this is one of those moments where it becomes very clear that it's not really about what the Fed is going to do next week. It's about what they should be expected to do over the foreseeable future, right? Over time. And when you consider that Kevin Warsh has been militant about his dedication to delivering on the 2% inflation target, the logical expectation, given all these new developments, is that they should keep rates higher for longer. And that's what investors are reacting to. Let's also keep in mind that the last time 10-year yields were hanging around this 4.68 area, mortgage rates were a full 50 basis points higher than they are today. So mortgage rates and house prices have been remarkably resilient, which means real estate remains a great way to build wealth for American families. So before I leave, let's just reflect real quick on what's going to happen next week around the Fed. If the Fed elects to remain on hold, don't expect markets to breathe a big sigh of relief. It's really going to be about what the tone that Kevin Warsh strikes in his press conference afterwards. Most likely scenario, I would say, is that the Fed remains on hold, and but it's a hawkish hold where they elect to leave rates unchanged, but reiterate their commitment to battling inflation and their willingness to act quickly if they need to. The less likely scenario, but still very possible, it would be a surprise hike. It would be a bold and clear move against inflation, but at a time when geopolitical headlines are dealing out rate shocks on the daily, I just don't think that would be well received by the markets, and I don't think the Fed really wants to break things that bad. And oh, by the way, let's also keep in mind that despite the fact that Wednesday is probably the most significant FOMC meeting we've had in 2026, maybe in the last couple of years, the Iran headlines will continue to be the main driver of rates next week and into the future. So that's all I got for you this week, folks. I hope you have a great weekend, and we'll see you next time.